Hello and welcome to the Audit Guidebook channel. This is Module 5 in our accounting series, and today we're tackling a really important topic, understanding accounting errors. We always hear that accounting is the language of business. It's what tells you if a company is winning or losing. So the big question is, what happens when that language gets spoken incorrectly? We're going to dive right in to understand what these errors are, why they happen, and the huge impact they can have. All right, here's our game plan for today. We'll kick things off with the fundamentals, establishing accounting as the language of business. Then we'll get into the mistakes, defining what unintentional financial misstatements are. From there, we'll break down the different types of errors, dig into the root causes, and finally, we'll wrap up by looking at why financial accuracy is just, well, non-negotiable. Okay, let's jump into our first section, the language of business. It just makes sense, right? Before we can really dissect the mistakes, we have to be on the same page about the rules of the game and what accounting is meant to do. So what is accounting really? Well, at its core, it's this whole process. You're recording, classifying, summarizing, and then interpreting financial transactions. But think of it this way. It's the engine that takes all the chaotic, raw financial data, every single sale, every purchase order, and transforms it into a clear, coherent story that helps people make crucial business decisions. And this right here is the best way to think about it. It's an analogy that really sticks because it's true. If you want to understand the health, the performance, and the strategic position of any company, you absolutely have to be able to read and understand its financial statements. Accounting is the language that tells that entire story. And every language has its own grammar and structure. In accounting, these 5 functions are the essential building blocks. It all starts with meticulously recording every single transaction. Then you're classifying them into logical groups, summarizing them into reports like the balance sheet, interpreting what it all means, and finally, reporting that vital information out to stakeholders. All right, moving into Section 2. We've just laid out the ideal scenario for how accounting should work. Now let's explore what happens when things go wrong, when that language of business is, well, spoken incorrectly. Think about it for a second. In a regular conversation, just one single misplaced word can completely change the meaning of a sentence. In accounting, it's the same principle, but the stakes are so much higher. A single error can distort the entire financial picture of an organization, and that can lead to some really poor decisions and a serious loss of trust. And here we have our key definition for today. An accounting error is an unintentional mistake. I really want to emphasize that word, unintentional. This is the critical distinction that separates an error from fraud. Fraud is a deliberate, calculated attempt to deceive. What we're focusing on here are the honest-to-goodness accidental slips that can still cause huge, huge problems. So that brings us to Section 3, a typology of errors. You see, to fix these mistakes effectively, you first have to know what you're looking for. So let's classify the different kinds of accounting errors you're likely to encounter. Let's start with the 2 big ones. First, you have an error of omission. This is pretty simple. A transaction is just forgotten. It's completely or partially left out. On the other hand, you have an error of commission. This is when a transaction is recorded, but it's done incorrectly, maybe the wrong dollar amount or the wrong account. So think of it like this. Omission is a blank space where there should be a word, and commission is a word with a typo in it. This next one is less about numbers and more about the rules of the game. An error of principle happens when you fundamentally misunderstand or misapply an accounting standard, like GAAP or IFRS. A perfect example is buying a new delivery truck, which is an asset, but mistakenly recording it as a simple one-time travel expense. This completely misrepresents the company's assets and its profitability. Now, these are particularly tricky. A compensating error is when you have at least 2 mistakes that, just by pure coincidence, perfectly offset each other. Let's say an expense is overstated by $500, but somewhere else, an income item is also overstated by $500. When you run your trial balance, everything looks like it adds up perfectly. Your books appear to balance, but the underlying information is just plain wrong, which makes these errors incredibly difficult to detect. An error of original entry happens right at the very beginning of the process. An incorrect amount gets punched into the first record, the book of original entry. So, for example, you get a check for $950, but it gets logged as $590. From that point on, every subsequent report that pulls that number will be incorrect. It's a classic garbage in, garbage out problem. And finally, we have the error of duplication. This one is pretty straightforward. A single transaction is accidentally recorded 2 or more times. The classic case is entering the same payment to a supplier twice. It's an easy mistake to make, but it overstates your expenses and understates your cash balance. So this table does a great job of summing it all up. You've got omission, where a transaction is missed; commission, where it's recorded incorrectly; principal, where a fundamental rule is broken; compensating, where errors hide each other; original entry, a mistake right at the source; and of course duplication, where an entry is repeated. This is a fantastic summary to keep in mind. Okay, on to section 4, the root causes of error. We have now identified the what, so it's time to explore the why. What causes these mistakes to happen in the first place? So why do accounting errors happen? Honestly, it's rarely just one thing. Sometimes it is simple human error. Someone's tired or distracted. But other times, the problem is much more systemic. Inadequate internal controls, for instance, means there's no safety net, no one double-checking the work. Poor record-keeping systems can make mistakes almost inevitable. Then you add in the intense time pressure to close the books, the genuine difficulty of handling complex transactions, and a lack of proper supervision, and you've basically created a perfect storm for errors to occur. Finally, let's tackle Section 5, ensuring financial accuracy. We know what errors are and why they happen, but now we come to the most important question of all. Why does it matter so much? Ultimately, it all comes down to this. Accurate financial statements are the absolute bedrock of a good business. They let management make informed, strategic decisions, they ensure the company is complying with laws and regulations, and, critically, they build and maintain the trust of investors, lenders, and the public. Any accounting error, no matter how small, erodes all 3 of those pillars. And I'll leave you with a final thought to mull over. We've seen errors that come from simple mistakes and errors that come from systemic failures. But which type do you think poses the greatest hidden risk to a business? Is it the one that's hardest to find, like a compensating error? Or is it the one that fundamentally misrepresents the business, like an error of principle? Something to think about. And that's our explainer on accounting errors. We really hope this breakdown gives you a clearer understanding of how these mistakes can happen and, more importantly, why preventing them is so vital for any organization. Thank you so much for joining us for Module 5. If you found this explainer valuable, please hit that like button, subscribe to our channel, and be sure to watch the full accounting series. We appreciate you being here.